All right, well, thank you for joining us for part 2 of our webinar on Secure 2.0. I'm joined again by Greg Needles, Bill Ryan, and Marla Kreindler for part 2 of this discussion. And here we're going to take a little bit of a longer and deeper look at some of the provisions we've already talked about in part 1, and then maybe talk about some other provisions we didn't get to yet. So we'll aim to provide some insight on what sponsors should think about before they add these certain optional provisions. So I think we'll start with one that I find pretty interesting, and it's a ways off now. It's not going to come in for a couple years, but the Savers Credit Match for low-income participants. So this, in my opinion, has potential to bring a lot of people that aren't currently in the DC plan into the plan, and also could help to enhance a match, or even for a plan that doesn't have a match, it could be a way that they can offer that type of benefit. So maybe we can first start by talking about what the current Savers Credit is, and what that means for participants and what the change will mean. So Greg, if you could maybe give us the setup on the current Savers Credit and what the new match is.
All right, Dan, I'll try. The Savers Credit always gives me a headache when I try to go through it. So, and that's because it's so complicated. And I think it's one of those provisions that got into the code with great intentions, and that is to entice people who might not normally have the discretionary income to make retirement contributions, to entice them to do so. But when you look at what the requirements are with the credit, it's pretty complicated, even for a tax attorney like myself, much less a lay person who wants to take advantage of this. It's targeted at low-income individuals, and if they make up to $2,000 contributions, that's for a single person, $4,000 for filing a joint return, they would get a credit on their contributions into the retirement plan or into an IRA. The amount that's eligible for the credit is, and this is where it gets even more complicated, is that it's a tiered approach within the code, and that's based on income. And so, trying to communicate that to somebody when you're saying you could get a credit, but we're not quite sure what that credit is because we have to look at your income, it takes a little gloss off the sheen of the credit. And then if you do qualify for the credit and you have less in the way of adjusted gross income than the credit amount, you lose the excess amount of the credit that otherwise wouldn't apply because you've got credit on all your taxes. So it's a great, it's a great idea and great policy, but it was difficult, and I think it is still difficult to embrace from a participant's perspective. Fast forward now to Secure 2.0, where we now have the Savers Match, and Congress, I think, was informed that maybe the credit wasn't working as well, and this is another way, and maybe even a better way, to get people into the system. And with the Savers Match, again, it's income based and it's targeted for lower income workers. If you make a $2,000 contribution up to a $2,000 contribution into your employer's plan or an IRA, the government will match that, and they'll match up to 50% of that contribution. And that match could go into an employer plan if the employer plan accepts it. It's an optional adoption on the employer's part, or if not, it can go into an IRA. And this is terrific because it's easier to communicate, I should say. There's still a phase out at certain income levels, people start to phase out, but that's more manageable as far as the communications challenges are concerned. The participant doesn't have to do anything. They just need to make the contribution. The IRS calculates the match. They're tasked with that. And then the government makes the contribution into the employee's plan or the participant's plan, assuming employers adopted it or into the IRA. From an employer perspective, there's really little that the employers have to do here other than make sure that if they do adopt the provision, they accept the match and then they administer it as they would any other kind of contribution. The fact that there's certain limits, obviously, that apply to contributions that go into the plan, into an employer plan, they don't apply to these contributions. So it really is, from an employer's perspective, an easy adoption of a very worthwhile provision. It'll be interesting to see how many employers take this up. Now, as Dan mentioned, it's a couple of years away. It's actually, what, 4, maybe 5 years away. It goes into effect in 2027. And there's a lot of regulation that's going to be promulgated between now and then so that you as an employer know exactly what you're getting yourselves into. But generally speaking, it's great provision to add to the code.
Okay, Bill, let's pull you into this conversation. Obviously, this is sounds like it's an easy win if you can add a match to a plan without actually contributing as an employer. So maybe talk about that.
Yeah, it's exactly what Greg and Marla were saying. There's a lot of tailwinds and positive. Granted, it may be 4 or 5 years out. If I think about definitionally low-income participants, it tends to be younger participants too. You're earlier in your career where you make your lowest wages. So there's going to be a tailwind to get participants starting even sooner than maybe they hadn't. And you're going to get that compound dollars into a plan. You're going to get more attachment and alignment with your employer and your plan, which has nothing but upside, getting more money into the plan and helping those participants with outcomes. I mean, this is part 2 where we're free-forming it. I'm excited about it. I'm excited about it for a lot of reasons. It may close the gap on a lot of plans that have 90 percentile participation. Maybe you're 95, maybe you're 96, but there's a lot of positives here.
Okay, Marla, maybe you can talk about what this means for policy long term, in for the industry. Obviously, it's a ways off, but look into the future and see what that could mean.
Yeah, thank you. I get excited and interested about this provision too. It's like when I hear it being talked about to Greg, I want to say, wait a minute, the government's making the contributions. What does that mean? We haven't seen that in DC plans to date for private employer DC plans. And does this mean that, we know that prior administrations were interested in programs where that the federal government would offer a universal DC plan that for employers that don't have plans or don't want to have plans that could be used and provide auto enrollment? Is this a precursor to that? Maybe it's basically going to be a way for the government to be involved in private employer DC plans, not as a sponsor, but providing contributions. So I find this provision, in addition to just being positive for solving, what Greg was talking about on the complications of the credit, just really interesting from a policy perspective. So we'll keep an eye on this one.
For sure. And now back to Bill here. Bill, I said in part 1 we aren't going to talk too much about some of the provisions around new plans and startups, but in 2025, new plans are going to be required to have auto enrollment and auto escalation. So, do you think existing plans will start to adopt that in higher numbers since Congress has given somewhat of a tacit endorsement of those provisions?
Yeah, as you can appreciate, within defined contribution, inertia and trends are extremely important. It just happens to be we're in the annual trends season for NEPC, and thinking about the presentations we're giving currently, there's numbers in there that talk about prevalence of any type of investment options, savings rates, what have you. As this works through the system and the denominator gets larger, more plans have auto enrollment, more plans, new or old, start adopting these escalations, you're going to see the migration that it will create momentum as a tailwind to follow these. And we've seen over the years, most plans did the default at the safe harbor level. If there's opportunity to provide coverage going forward, even for existing plans to increase their auto enrollments, I think it's going to have a lot of positive impacts of the velocity in plan. What will be interesting, that something that we're starting to think through, are what are the knock-on effects? That where does there maybe an offsetting casualty, if you will? If you think about managed accounts, for perspective, one of the benefits there has been the savings advice that you get. And so if you have increased savings in through these employer-driven mechanisms, especially for younger participants, does this dilute some of that value and benefit for managed accounts that people are paying a fee for? Because all boats will rise, all savings rates will go up, and therefore putting somewhat of a diminishing benefit on that savings advice, putting more focus on the advice. So it's going to be interesting to see both the positive and then the knock-on effects in the ecosystem. Every regulation we have spawns something that we didn't anticipate. That's something I'd be watching for 5 or 10 years from now.
Great. So in part one, we talked about RMD changes with Secure 2.0. And can we talk about some of the other ways that 2.0 is addressing the needs of older workers? Maybe Greg and Marla, you can highlight some of those items.
Sure, happy to do that, Dan. First, I think there's been additional movement on the Roth side. There's a lot about Roth in that act. And one of the provisions that's employee friendly is the opportunity to increase the amount that you can contribute as a catch-up contribution from whatever the limit is at 2 to 3 years from now to $10,000. So you, a participant who's either 60 to 63 will have the opportunity to make an enhanced Roth contribution to their account. And now, if you're 64, you're not going to be able to do that. So you have to take advantage of that window. But it increases the amount that somebody who's nearing retirement gives them an additional kicker to make sure that they've got enough for retirement. And that's great. I mean, that's another benefit that for the retirement system to get more money in there, and it's a benefit for those who might not have had the opportunity to save earlier in their career to catch up on the contributions that they missed out on before. Another feature of Secure 2.0 is accessing your account for to pay long-term care premiums, where we've seen that system evolve and that particular benefit evolve from a group policy that an employer might have sponsored to now just individual policies that are held by employees. This gives the employer an opportunity to allow their employees to take the money out of their retirement account up to $2,500 a year and use it to pay their premiums for long-term care insurance. Now, of course, there's some obligation on the employer or the plan administrator's part. The employee and participant has to prove that they actually do have a premium to pay, and so they have to provide a proof of insurance and that shows the premium amount. But if they do that, and if you're willing to take on that administrative burden, if it is really a burden, then this allows participants to be able to plan for that part of retirement that I think everybody foresees at some point needing that kind of care. And $2,500, it's not a big, it doesn't have a big impact on the plan. And finally, there were some changes in Secure to remove the barriers that the RMD requirements had on lifetime income. As we all know, I mean, the IRS and the DOL and Congress through legislation have been promoting lifetime income products, annuities, is a form of distribution in defined contribution plans, because they've seen, as Marla mentioned earlier, people take their account balances out in lump sums and then go ahead and spend it instead of rolling it over into an IRA. They're taking it out of the system and they're left just with a retirement based on Social Security, which is certainly not enough. So the policy behind lifetime income was, we're going to give them an opportunity to put it away in an annuity to provide them an income stream for the remainder of their lives, to supplement Social Security, so they'll have an adequate retirement. But then when push came to shove and we started looking at how this applies in the context of RMD, it goes to those unintended consequences that Bill mentioned earlier, where the RMD rules weren't changed to take that into account. So the annuity products that would qualify under what were the prior RMD rules before Secure 2.0 were generally annuities that didn't allow for any kind of increase, well, a minor increase year over year. They didn't provide any kind of access to participants if they needed to access their accounts in the form of an accelerated lump sum. If a participant were to die prematurely, there wouldn't be any kind of refund of their death benefits. I mean, it wouldn't be any kind of refund of their premiums through a death benefit. So these were all features that are available in annuity products, but weren't permitted because there are RMD rules. And it made lifetime income products less desirable on participants' parts. And so you don't see a lot of take up on this, because if a participant is going to be locked into this account or this annuity with very little flexibility, they're just going to keep their own account and manage it and have control over it and access to it. So what Congress did with 2.0 was that they're changing the rules. They're allowing annuities that increase over time, and you can have an annuity that provides for 5% annual increase, up to a 5% annual increase, so that your income increases to meet inflationary needs over your lifetime. For those people that get into an annuity and all of a sudden realize I need the money now for whatever reason, Congress has provided that you can take a lump sum distribution from the annuity. Likewise, if you need it for an emergency and want to accelerate it, your annuity and make it a lump sum for one particular year, you can do that under the RMD rules now. And finally, for death benefits, so if you haven't been, if you died prematurely, you still haven't recovered your premium payments, you're permitted to do so. Your beneficiaries are permitted to receive a refund of the remaining premium payments that were made into the policy. So these are all going to be make these vehicles much more attractive to plan participants. And the question is going to be, whether it is going to move the take-up rate. I think it will, but there's going to be a lot of communication that goes between now and then, when that take-up rate goes up, as well as the industry embracing it and really, quote, selling it to plan administrators as something of a benefit to participants that they will embrace. And that's going to be somewhat of an uphill climb because they haven't embraced it to date. So.
Yeah, I think this one in particular is really, I spent some time recently on a product thinking about RMDs and annuities, and this just seemed like a very welcome change. So I was glad to see that. And the other that I was going to mention was just the expanded availability of QLACs. So what's a QLAC? It's a qualified longevity annuity contract, and these are deferred income annuities that you buy out of, say, 401k plan assets that are intended to begin payment not currently. That's why it's called a deferred income annuity, but near the end of the participant's life expectancy, say typically around age 85. And what these annuities are designed to do is that since they're not paying out currently, then that means that they're not as expensive because they don't pay out until someone gets to age 85. So, but they're designed to prevent individuals from outliving their retirement savings. So what a good feature and something that people worry about, right? And so we it's something that we've talked about in the industry from a policy perspective of allowing for investments in QLACs more broadly is something that could then help take that worry off of participants and turn our DC plan into more of a DB, the DBization of DC plans that we've talked about a lot. And so what did Secure 2.0 do? It got rid of some limits that we saw previously on QLAC. So the limits were the lesser of 25% of the account or 145,000, and Secure 2.0 repealed the 25% limit, increased the dollar limit to $200,000, and this will be indexed. And so, we see this as good news for expanded availability for QLACs.
Great. So let's ask Bill the tough question now, and look into the future. And Bill, do you think this will finally mean more widespread adoption of retirement income annuity products?
Yeah, and I think it was important for you to caveat or qualify with retirement income. I heard Greg talk about lifetime income. And if you appease me for a second, I think it's something we learned like in elementary school, that a square is a rectangle, but a rectangle is not a square. As we think about retirement income isn't insurance, but insurance is retirement income. And as we talk to our clients, we are actually we're making the statement, to Greg's point about embracing it and supporting the initiative, that 9 out of 10 of our clients already have retirement income. And what do I mean by that? 90% of our clients have a target date fund and systematic distribution set up by their record keeper. The target date fund has an asset allocation intended to support income in retirement. So we have that. Now, 4% of our clients have a lifetime income solution. That's the gap that we need to close or figure out how to spend time on that. I agree with what Marla and Greg said. There's tailwinds and regulatory relief to make this more palatable. The wider the relief becomes, the more applicable these annuity solutions can become to more of the population. If it's too acute, not all participants can use it. It makes decision-making very difficult. It is a commitment by us at NEPC, Dan, and you know that. One of our top 3 things this calendar year is to talk about with our clients how to define retirement income better, how to work through that decision tree, and to make sure that we're comfortable with what we have going forward. So to Greg's point again, if we're able to help our clients break this down to something as simple as a rectangle and a square, we think that we can bring that to participants the same way going forward, and there'll be increased adoption of retirement income, self-insured vehicles and pooled insured, vehicles.
All right, so let's switch gears then to 403B plans. We'll spend a couple minutes on that. And one of probably the more confusing parts of Secure 2.0 is what it attempted to do for collective trust, CITs, and 403B plans. So if we could for a moment talk about what Secure 2.0 did for those, and then also where it fell short, and then if there's any alternative approaches to adding those types of funds in 403B plans.
Yeah, sure. I mean, this was an interesting part of watching how legislation works and gets adopted or doesn't get adopted, right? So we've seen from a policy perspective that there was interest in Congress in taking away the limitations that apply generally to 403B plans. And so I say generally because we know that investments for certain types of 403B plans, like I'll say governmental, grandfathered governmental plans and certain church 403B plans, they've had more broader offerings similar to what we might see for 401k plans generally. But other types of 403B plans have been limited previously to investing only in insurance contracts or in registered investment companies, meaning mutual funds. And so what Secure was trying to do is it was trying to amend the 403B tax code to say, let's loosen that restriction that limits 403Bs from generally from investing only in mutual funds and insurance contracts. And let's include group trusts, and understanding that group trust is the tax way of saying collective trust for most collective trusts. And then let's also amend the securities laws that have a restriction currently that generally says 403B plans cannot invest in collective trust. So let's do both of those things. So what happened once Secure got adopted is we have the provision that amends the tax code to say 403Bs can invest in group trust, but the companion securities law provisions were not adopted. So what we've been hearing and what we agree with is that CITs cannot include this general category of 403B plans because the securities laws were not adopted. All true. But we can step back and say, but wait a minute, there was a law that was passed. The tax code was amended, and the tax code was amended to allow group trusts. Those group trusts were not previously available to these types of 403B plans, and now they are. And then we sort of think about it and we say, well, are all group trusts CITs? No, actually, I'd say many of them are, and most CITs that are out there are group trusts, right? But there are CITs that can be created that are I'm sorry, there are group trusts that can be created that are not collective trusts. And those group trusts are available to institutional 403B plans. And this is where some opportunity might be created. And what that opportunity is that these institutional 403B plans could create a white label. The SEC would call it a generic investment option. I call it a white label investment option, like a target date fund where the plan creates a separately managed account in its trust or custodial arrangement, and it blends that investment by investing in multiple group trusts or other investments that are permitted for these types of 403B plans. So think like a target date fund that invests in multiple different group trusts, or think of a stable value fund that invests in multiple different group trusts that allow then for this investment. And why do I say multiple different? Because there's a series of SEC no action letters that we probably don't have a lot of time to go into it on this call, but just suffice it to say that some of the general rules on those no action letters is that the white label investment option has to have multiple group trusts that would be invested, that would be a part of the white label investment option, and that no one of the group trust investments could make up more than 50% of the white label investment option. And so we think institutional plan sponsor clients are already know how to do custom target date funds, to do white labeling, and this is an opportunity that we see for large institutional 403B plans to follow suit and then allow for group trusts to be added to their investment lineup.
Bill, maybe you want to capitalize on those thoughts since we're building white labels for a lot of our larger clients. How we can make that work with the current rules.
Yeah, absolutely. And if you're an avid reader of pension investments, or if you're not, you may have seen Marla and I quoted earlier this year in January on this topic. I think we were the only two that stood out from the pack to talk about that. And to give fair credit, it was in preparation for this webinar. Marla had spent a fair amount of time educating us at NEPC on how to accomplish that, and allowed both of us to articulate what we can help clients with. And if what I said there, and I'll say again in this format, to Marla's point about having multiple group trusts in a single white label or generic investment, you probably need over $100 million or so in an asset class, or maybe $2 billion in a plan, to have some of the other economics make sense. And this would be true for any custom structure. It's not limited to group trusts or CITs. So if you are a 403B plan that has over $100 million in an asset class, or $500 million in an asset class, I think this is something to explore. From a fee structure standpoint, you can get the same investment strategies you have today and bring down the cost structure by taking advantage of the tax code changes that Marla just outlined.
Yeah, what's interesting is the SEC rules that I was referring to, the no action letters, they would basically say you have to have a 403B plan with at least 25 million. But I think what we're anticipating here is that in order to, this isn't the easy button, creating your own institutional white label separate account. And so what we're saying here is that we think the larger plans will be able to work with all the parties involved to get this together. And I guess I would say the other question that people have asked, well, because Secure was ready to adopt, the SEC corresponding to securities law changes, shouldn't we just wait for that? And that's a good question, right? Are the savings that Bill talked about, are they really going to be worth it in the near term for clients to work through these questions and set up these institutional products, or do you wait for Secure 2.0? And that's part of what we're hearing, is that failure to adopt the securities law provisions wasn't necessarily like a technical issue, like we're hearing about some of the other technical corrections that might be needed on Secure 2.0. But if this was something that was more intentional, then is it going to take longer than technical corrections to get this adopted? Is that, this year, maybe not, 2 years, even longer. And so it really could present an opportunity for those institutional plans that want to do something currently and not wait.
Yeah, and I won't ask anybody to make a guess on when that securities law is adopted, because it's really almost impossible to forecast that one. So, so Bill, let's stick with you here on in somewhat related to 403B plans as well. Maybe we could talk about pooled employer plans and multiple employer plans. Can you talk about ways that Secure 2.0 builds on that, those rules that were established with Secure 1.0?
Yeah, an exciting provision was the inclusion of 403B plans to be eligible to join a pooled employer plan. So to eliminate the common nexus, have multiple universities, join a pooled employer plan, maybe even hospital systems, what have you. Really excited about the development here. What we've seen maybe over the past 2 decades is consolidation in a lot of areas. We've seen consolidations between asset managers buying each other, record keepers buying each other. I think our recent Plan and Trend survey had 12 record keepers responded. 10 years ago, it was 24. That's not because things have changed, other than there's been consolidation. The last thing that hasn't been consolidated is the employer plans. These mechanisms allow employers to port their plans to a centralized entity that can manage them for them, creating larger plans like in other countries, like in Australia, which could take advantage of the provisions that Marla just outlined, because you'd have bulkier assets together using group trust to drive down fees. I think what's been really interesting since Secure 1.0 to 2.0 is there have been entities that have forged the way in the 401k space. So we're actually making progress on the educational side of it. But I think over the next couple of years, we're going to get past that part of the learning curve, and it'll be more comfortable to talk about what pooled employer plans are and how they can actually benefit employers.
Great. So I think we'll switch gears a bit to benchmarks, something a little bit more closely related to our wheelhouse and investments. So Marla, if you could maybe talk about what we currently have for custom benchmarks, mostly around target date funds, and how Secure 2.0 attempts to address custom benchmarks.
Yeah, this is interesting, and something that regulations are to be issued on it by the end of December of 2024. So at least another year out. But basically, the Department of Labor has been directed to issue participant disclosure, or as an amendment to the participant disclosure rules, a new way that we can report benchmarks against, for performance against the plan's investment options. And so prior to passage of Secure 2.0, the DOL's participant disclosure rules under 404 required each plan's investment options historical performance to be benchmarked in participant reporting against an appropriate broad-based securities market index. So think about that, appropriate broad-based securities market index. But what we know within retirement plans currently is that that's challenging when you have a target date fund that has, or a life cycle fund that has different mixes of asset classes and glide paths. And it's also been, problematic, for stable value funds, where you don't just have securities in a stable value fund, you have these wrap contracts that behave more like insurance contracts. And so how do you get an index for a target date fund that's going to be a broad-based securities market index that's going to just really fit what we see in target date funds with the complexity of the glide paths and the different asset allocations? And the answer to that is, well, it's been challenging in the past, because even if you look at like the glide paths from different target date funds, I've seen graphs of that, and Bill, you could talk about that more, about how there's just so many differences among them, that what was happening is we weren't giving, you think of what's a benchmark doing, you're trying to help benchmark against the performance, but we weren't seeing, an apples to apples comparison, sort of apples to orange. And so what has Secure 2.0 done? It's directed DOL to allow for, basically to create a custom and other benchmarks that could be used that do not necessarily have to meet this broad-based securities market index. So it could be a blend of broad-based securities market indexes. So we're going to need to wait to see what DOL has to say about it. But, again, I think it's just a really interesting and a good step forward for a problem that we've seen over the past few years with benchmarking in these plans.
Yeah, it sounds like it could be largely positive, but maybe Bill, if you could, is there some chance that this could create some confusion or make a fiduciary's job harder with guidelines around this?
I actually, as being a former plan sponsor and now a longtime consultant, it's going to make the communication easier. I thought about how we had historically interpreted the fact sheets. Broad-based index may have been the S&P 500, maybe it's the bond ag. And you have a pure equity play or pure fixed income play against a diversified return stream. And participants are like, it's either really outperforming the bond ag or really underperforming the S&P. And do they think they have a bad investment? So I think this is going to clear things up, both from the performance monitoring as a fiduciary, as well as the simplicity of participants understanding what they're holding.
Yeah, and there are requirements in the, in what Secure adopted that some may say, well, is this going to create more complications? Like that the index blend is supposed to be reviewed at least once a year. But Bill, I'm assuming you can help with that, right? And that the index blend is communicated to participants in a manner that can be understood by the average participant. Okay, well, we can all in the industry work through that. So there are some pieces of it, but as we're going to want to keep an eye on how DOL looks at it. And actually, Congress says that they want to keep an eye on how this is working, because they want DOL to report to Congress on the effectiveness of its benchmarking, 3 years after the applicability of the reg. So Congress is going to say, yeah, we should all keep an eye on this, and hopefully it's going to move us in the right direction.
Great. So a lot more to come on that one. So let's switch gears now to financial wellness. Obviously, we touched on some of the items that might be under that financial wellness umbrella in part one. But if Marla and Greg, maybe you can talk a little more about the financial wellness items in Secure 2.0 and how that might enhance savings, and on the other end of it, how it could possibly hinder savings.
Yeah, so financial wellness, one of the things in 2.0 was the matching contributions for student loan payments, something that has been around for a few years, though there's been some regulatory concerns about whether it's permitted. Congress eliminated that, and they added a provision to the Internal Revenue Code that sanctions matching contributions for student loan payments. This is great development in bringing people in, particularly younger employees, younger participants who don't have the discretionary income to make a contribution. I mean, it's the choices: pay off my student loan or make a contribution into my employer's 401k. We know where the money's going to be going. So by permitting a matching contribution on those student loan payments, you're now bringing that person into the system. And that's great. I mean, that's great for the individual participant, and it's great from a policy perspective because it's adding more people to the system, and that's something that we're trying to drive in this country. Now, the downside is that there are already some employees that are making contributions into the plan and also are paying off their student loans. And this may incent them to say, hey, if I can get a match based on my student loan payment, maybe I'll take that money that I've been putting in my 401k and use it to spend it elsewhere. So it may take that money out of the system. My hope is that once that individual gets their student loan paid off, because they have an aptitude for savings that they were previously making a 401k contribution to the system, they'll take that money that they're using to pay off their student loan and make their contribution to their 401k. But I'm kind of a half glass full kind of guy as opposed to half glass empty. So others might have a different view.
Yeah, I appreciate the optimism there. Marla, maybe, if we could revisit the pension-linked emergency savings accounts that we talked about in part one, and, talk about how that can enhance the financial wellness of participants.
Yeah, the pension-linked emergency savings accounts, but also the distributions for emergency financial needs or immediate financial needs. And both of these provisions, they're two separate provisions, one to allow for savings accounts, the other to allow for withdrawals. As I look at them from a policy perspective and think it's going to help participants that are worried about putting money in the plan and not having access to it. I think of someone that I knew a few years back who I spent a lot of time talking to him about, contributing to his 401k plan, and he did that, and then he had an emergency issue and took the money out and was subject to an excise tax. Like how horrible was that? And it just ended up being a bad experience, as opposed to what you want to see as a positive experience. And for that type of person, I think about it as, yeah, this is going to take the excise tax bite off of it. It's going to give them the ability to know that, yeah, this isn't locked up. You don't have to quit to get the money. You don't have to show a hardship. You have $1,000 available or 2,500 available based on, which of these provisions we're adopting. And I think that is something that will be a positive to bring people in the plan. Now, of course, the negative of it is the administration of these additional programs. And, those that think, hey, emergency savings should be dealt with separately, and this is a retirement plan, it's not a bank account, and administration is going to become difficult, and all these small accounts, how will we deal with them? But again, from my perspective, others may disagree, that I see it as a plus and a way to bring in to try to promote, broader coverage of retirement savings from those that don't have it and who are just afraid to do it because they're worried about tying up their funds.
Great. Now, I think we're getting close to our time limit here, but before we close out, I know there's a lot of items in Secure 2.0, and Marla, you talked about one of them that Congress has asked for down the road in terms of studies that they want to examine parts of the system that could be improved. So maybe before we close, talk about some of those things that are coming out in the future with mandated by Secure 2.0.
Yeah, one of the reasons I've always liked to work in this area is because there's always things that are changing. And so, for those of us who like dealing with changes and learning more and thinking about policy different, this is, for me, it's always just been so interesting and making it worthwhile to work in. And what we saw here in Secure 2.0 is actually, Congress saying to different regulators, hey, go out and think about this. Like, we want you to think about these things further and then come back to us with studies. And what does that mean? Does that mean that there will necessarily be regulations on it? No, but on the other hand, if they're having a government agency think about it, when you think about something deeply, you can always think of ways to improve it. And so I think we will expect to see more things down the road that are at least anticipated or supported by Secure 2.0, even if not mandated by it. And some of those areas are Form 5500 reporting and disclosures, participant fee disclosures. Can we improve participant fee disclosures? Yeah, probably. And we'll think about that. The 402F notices that are given to employees on distribution. Greg's shaking his head, yes. It's like, can we make those better? Probably, right? Treasury guidance on how to simplify rollovers more. We talked about, some of the changes on auto portability or allowing for, self-certification on different types of withdrawals and whatnot. And here again, is Treasury or is Congress going to Treasury to say, think about how can we simplify this so that we can address linkage? And I think that's really interesting. And another that came a little bit, I don't know if we're almost at baseball season, but to say, yeah, out of left field, would be just, studying the impact of inflation on retirement savings. And I find that really interesting and something that we're all thinking about and keeping an eye on now. And so it's interesting to see Congress wanting us to have the government think about that and come back and talk about how can we work on that with retirement savings. Does that mean more lifetime income? What does it mean? I don't know. We'll see.
And
So
one
stay
thing-
tuned. Yeah.
One thing I know, Dan, as you wrap us up, something that Marla said at the start of those comments was about her joy for the industry and embracing change. And I think us at NEPC, and you know this, it's, you know, I've put in all of our annual goals for this year is to embrace change and to understand the other side of the argument. And what we're trying to do and what our intention is within the NEPC DC team is understand there are two sides of the argument. For every topic we've talked about, there's going to be nuances of how you implement it, nuances of why it's right for some sets of your population. And it's an exciting reason for why I'm also in the industry and working at NEPC. I really like the culture and how we work with our clients and just our flexibility in navigating change. So I thank you for everything you've done for us, Marla and Greg, and the education you've given us, especially on the 403B we talked about earlier. I think both part 1 and part 2 have been a pretty fun conversation. So Dan, I wanted just to interject there as you kind of wrap us up.
Sure. Thanks, Bill. And yeah, thank you, Marla, Greg. Marla, since you've been a part of our webinar on 1.0 and now 2.0, if there is a 3.0, you can bet you'll get a call from me to join us again. So thank you all. Thanks to the audience who tuned in. Obviously, if there's any questions, feel free to reach out to your NEPC consultant and they'll make sure it gets to the right place. And if obviously it's not a live webinar, but we can certainly answer questions offline as well. So thank you all.
Thank you.
Thank you.
Thank you.